6 out of 10 Americans bet on the stock market. 7 out of 10 lose. It's a peculiar paradox. More people investing than ever before, yet most walking away with empty pockets, while tech billionaires play musical chairs at the top of the wealth pyramid. September 11th, 2025, marks the day Larry Ellison dethroned Elon Musk as the world's richest person.
Founder and top shareholder of software giant Oracle has seen his net worth soar by $70 billion.
Is a beneficiary of massive new AI infrastructure spending and is nearing $1 trillion.
This is a trend that has exploded because of the pandemic. A new generation of investors, they are young, they are stuck at home with not a lot to do.
The Oracle founder's net worth exploded by $70 billion overnight. Not through some revolutionary product launch or paradigm-shifting innovation, but because his company whispered the magic incantation: artificial intelligence investments. 24 hours of speculation and boom, a fortune larger than most nations' GDP materializes from thin air. 4 days later, the script flipped. Musk, unwilling to surrender his crown, dropped over $1 billion, acquiring 2.6 million Tesla shares. The stock surged. His net worth ballooned by $6 billion in a single trading session, turning his billion-dollar bet into a spectacular profit before the closing bell. This isn't investing anymore. It's financial theater, where CEOs are both the directors and the lead actors, and retail investors hold tickets to a show they don't realize is rigged. Welcome to the new Wall Street, where AI has become the most valuable three-syllable word in capitalism, and tech giants have perfected the art of turning speculation into a legitimate business model. But understanding how we arrived at this moment requires rewinding nearly a century, back to when the stock market was something most Americans never dreamed of touching. Rewind to 1929. Only 3% of Americans owned stocks, yet that sliver of participation triggered a collapse that dragged the entire global economy into the abyss. That 3% would prove a preview, not an exception, a template for how concentrated speculation, no matter the era's technology, follows the same arc toward collapse. The stock market was an exclusive gentleman's club, mahogany desks, ticker tape, and financial instruments so complex they might as well have been written in Sanskrit. By the early 1950s, that figure had barely budged to 4%. Wall Street remained a fortress for the wealthy, investment vehicles wrapped in regulatory red tape and inaccessible to ordinary citizens. Then the 1980s arrived like a wrecking ball through that fortress wall. Mutual funds proliferated. Retirement plans expanded beyond the executive suite into factory break rooms and teacher lounges. The stock market transformed from a rich man's playground into what politicians sold as the great American wealth-building machine. In 1980, roughly 15% of households owned stocks. By the late 90s, that number had rocketed past 40%, fundamentally reshaping the American relationship with capitalism itself. If you made it this far in the video, please like and subscribe to the channel so we can continue to bring you quality content on the market. The internet accelerated this democratization into hyperdrive. Digital platforms obliterated traditional barriers. No broker required, no minimum investments, no phone calls to financial advisors who made you feel stupid for asking basic questions. In May 2006, watching Morgan Stanley shares climb 4% on merger news, you could participate from your laptop in your pajamas. The game had moved into every living room in America. The dot-com era reads like a medical examiner's report on collective delusion. Between 1995 and 2000, the NASDAQ Composite Index quintupled in value. Companies without revenue, without business models, without anything except .com attached to their names, attracted avalanches of capital. Pets.com, Webvan, eToys, the graveyard of enterprises that mistook a domain name for a destiny. Microsoft, Amazon, and Google led the charge to record highs. Champagne flowed in Silicon Valley. CNBC anchors could barely contain their enthusiasm analyzing another historic peak. The quality of this rally? Nobody asked the question until it was too late.
March 10, 2000, delivered the answer.
The Nasdaq began its 75% free fall over the next 3 years, vaporizing a quarter of its value in a single week. Trillions in market capitalization evaporated like morning mist under harsh sunlight. The lesson was brutal and clear. Technological enthusiasm, divorced from economic fundamentals, creates bubbles of catastrophic magnitude. Yet somehow, memory proved shorter than the market cycle itself. The next chapter in this story begins not on Wall Street, but in sports bars and online betting platforms. By 2010, Americans were pouring $40 billion annually into sports betting and online gambling, with double-digit growth rates as the sector digitized. Then March 2020 arrived and the world locked down. The NBA suspended its season. March Madness was canceled. The Kentucky Derby postponed. Suddenly, millions of bettors had stimulus checks, endless free time, and nowhere to place their action. They found Wall Street. This trend has exploded because of the pandemic, financial analysts explained, watching in real time as a new generation, young, restless, stuck at home, discovered commission-free trading apps. Robinhood and Charles Schwab weren't just offering investment platforms. They were providing digital slot machines with better marketing. Charles Schwab reported a 58% surge in new accounts during 2020. Retail trading volume doubled within months, jumping from 10% of total market activity in 2019 to 20% by mid-2020. Investment had mutated from long-term wealth strategy into short-term speculation, from patient accumulation into instant gratification gambling. The stage was set. Millions of Americans had discovered that watching numbers change on a screen triggered the same dopamine hit as watching their team score. This new army of day traders, armed with stimulus checks and unlimited time, needed only the right narrative to chase. Silicon Valley was about to give it to them. Artificial intelligence. Say it slowly. Feel how it rolls off the tongue, promising a future so advanced it borders on incomprehensible. Starting in 2022, these two words acquired supernatural power in financial markets, a verbal incantation capable of turning struggling companies into billion-dollar darlings overnight. Tech CEOs recognized the opportunity immediately. Mention AI in your quarterly earnings call, watch your stock price levitate. Announce AI integration into existing products, add hundreds of billions to market cap. The narrative became the product. The promise became the profit. NVIDIA mentioned AI 28 times in a single 2023 earnings call. Their stock jumped 200%. Microsoft announced AI features in Office and Bing. $500 billion in added market cap followed. Not from products in consumers' hands, but from promises in PowerPoint slides. The feeding frenzy extended beyond established giants. Startups with prototypes, with concepts, with nothing but pitch decks mentioning AI or machine learning, attracted investment rounds that would make venture capitalists from any previous era choke on their cappuccinos. Between 2022 and 2024, over 50 AI-linked startups reached unicorn status, valuations exceeding $1 billion, despite lacking consistent revenue or realistic profitability timelines. U.S. AI startups raised over $14 billion in 2025, nearly matching the entire previous year's total. Money flooded into companies whose business models remained theoretical, whose products existed primarily in investor presentations, whose success depended entirely on future breakthroughs that may or may not materialize. The Nasdaq surged 55% in 2023. Its best performance since 1999, that fateful year before the dot-com crash. This wasn't broad-based economic growth lifting all boats. This was concentrated wealth creation, driven by the so-called Magnificent Seven tech giants, each weaving compelling AI narratives that mesmerized investors. Jensen Huang of NVIDIA watched his personal fortune grow by over $30 billion in less than 12 months, not through salary, not through bonuses, through stock ownership in a company whose valuation skyrocketed because investors believed, or desperately wanted to believe, that AI chips represented the future of everything. retail investors piled in with reckless enthusiasm. Vonda Research tracked daily net retail purchases exceeding $150 million flowing into AI-related stocks during 2023, more than any other sector attracted. These weren't sophisticated institutional investors conducting deep due diligence. These were everyday Americans treating stock tickers like sports betting lines, wagering capital in pursuit of quick returns without understanding the fundamentals they were betting on. The parallels to previous bubbles are impossible to ignore. I do think there's some parallels here to what happened in the tech bubble, in the internet bubble in the 90s. Financial experts cautioned, their warnings drowned out by the sound of cash registers ringing up paper gains. History offers warnings that fade from memory faster than the losses themselves. The dot-com bubble's collapse erased over $5 trillion in market capitalization. Real savings, real retirement accounts, real dreams incinerated in the fire of speculation. The 2008 financial crisis demonstrated how unchecked innovation without regulatory guardrails can crater the global economy, costing millions their homes, their jobs, their futures. Yet here we stand again, watching Oracle's stock soar because Larry Ellison mentioned AI investments, watching Elon Musk manipulate Tesla's price through strategic share purchases, watching an entire market structure that increasingly resembles a rigged game where tech billionaires hold all the cards and retail investors play with house money they don't realize isn't theirs. 61% of Americans participate in the stock market, the highest rate globally. 71% lose money. That's not a coincidence. That's not bad luck. That's the inevitable outcome when Wall Street transforms from capital allocation mechanism into entertainment complex, when investment becomes indistinguishable from gambling, when AI matters more than actual intelligence. The question isn't whether this AI bubble will burst. History suggests it's not a question of if, but when. The real question is whether we'll learn anything this time, or whether we'll just wait for the next magic word. Quantum computing? Brain-computer interfaces? Fusion energy? To restart the cycle. The house always wins. Most Americans just haven't realized they're not placing the bets, they're what's being wagered. At Market Media, your opinion matters to us. Share your story in the comments below. Don't forget to subscribe and like the video.